Hi everyone. Today we are going to be working on lesson 12.2, which is determining payroll tax withholdings. So by the end of this lesson, you will be able to demonstrate the process for determining federal income tax withholdings, demonstrate the process for calculating Social Security and Medicare taxes, and explain the benefit of funding medical and retirement plans with pre-tax contributions. So up until this point in 12.1, we learned about how to calculate the gross wages, or basically everything that an employee is entitled to prior to any taxes being withheld. You, as the person responsible for payroll, needs to remove the payroll taxes from the employee's paychecks so that they can pay them to the government. So payroll taxes are taxes based on the payroll of a business. By law, a business is required to withhold certain payroll taxes from employees' salaries. Um, this is known as a payroll deduction, and a payroll deduction is actually any amount withheld from an employee's gross earnings. So not only are you withholding taxes, but there are other things that can be voluntarily withheld as well. Payroll taxes withheld are going to be a liability to the company until they pay that money to the government. And the federal income tax is one of the income taxes that's withheld, and that's required to be withheld from all 50 states. The state tax is going to vary state by state. So, a withholding allowance is a deduction from total earnings for each person legally supported by a taxpayer, including the employee. The information used to determine how much income tax to withhold is found on what's called a W 4. If you have a W 4, or if you have a job, you've filled out a W 4. This is also known as an employee's withholding allowance certificate. And by law, employers are required to have a current W 4 on file for every employee. This is a look at what the W 4 looks like. On it is going to have the name and address of the employee, their social security number, their marital status, and their withholding allowances. The withholding allowances are going to be determined by how many people that you are responsible for. And at the bottom, you're going to have the signature and the date. So, like I said, the amount of income tax withheld is based on the employee's marital status and number of deductions. Married employees will have less income tax withheld than a single employee with the same earnings. This is a look at an employee's income tax withholding schedule for single persons. So it's the number of people that you're ultimately responsible for and the amount of money that you're making, and you'll find the intersection. So if you are a single person, you would use this chart, choose the number of people you are responsible for, and then find the amount of money you make. The intersection is how much federal income tax is going to be withheld from the employee's paycheck. There's a similar form for the married people. It's the same thing. You're going to select the appropriate table, either married or single. You're going to locate the employee's earnings, find the number of deductions that they have indicated on their W 4, and that's the amount that's going to be on their removed from their paycheck for federal income tax. You can choose to increase or decrease this number. The amount is only going to either increase or decrease the amount of money that comes out of your paycheck for federal income tax. However, it all evens out when you pay your taxes the following year on April 15th when they're due. So you can choose to have more taken out and have a um, higher tax return, or you can have less taken out, and then you'll just owe when you pay taxes. Now, you also have to pay Social Security tax and Medicare tax. Social Security tax is a federal tax paid for old age survivors and disability insurance. Medicare tax is a federal tax paid for hospital insurance. These are taxes going to be paid by both the employer and the employee. And the amount, and it says it in your work together, the amount of Social Security that is going to come out is 6.2% of your total earnings. So that's your gross earnings before federal income taxes withholding. And then for Medicare, it's 1.45% of your total earnings. Now, accumulated earnings is the total gross earnings year to date for the employee, and the tax base is the maximum amount of earnings on which tax is calculated. So they are just some additional terms that we need to be familiar with and we'll be also using in the next section. Now, there's also voluntary deductions that you could have taken out of your paycheck. So, a qualified retirement plan is a retirement savings plan approved by the IRS that provides individuals with a tax benefit. There's different tax benefits for different retirement plans. A 401k is a qualified retirement plan sponsored by an employee. Often, businesses will match the employee's contributions. So, if you get a job and your employer offers a 401k match, you should put as much as possible, as much as the employer will match into that retirement fund because it's like free money. An IRA is a qualified retirement plan that provides most individuals with a deferred federal income tax benefit. So that means they'll take money out of your paycheck after it's been taxed, and then you pay, or before it's taxed, and then you pay money to the government, or you pay your taxes when you take it out. A Roth, you're paying the taxes on it first and then it grows tax free. I always recommend that once you get a job, you start with a Roth IRA because that is going to allow you to pay the least amount of taxes. You should talk to your parents and see what types of retirement plans they utilize because it's just good learning for the future. But I always recommend a Roth IRA as your first means of saving for the future. So those are just examples of um, deductions that would also be withheld by the payroll clerk. So only the contributions to a 401k and an IRA are deducted from the earnings before payroll taxes are calculated. Withdrawals from the 401k and the IRA are then going to be income tax, but withdrawals from the IRA of the Roth IRA are going to be tax free, like I said before. So, as the person responsible for payroll, it's important for you to understand these rules so you know exactly what to take out of an employee's paycheck.